It started with a dream to diversify our income, where four of us boldly stuck to what we knew and our passion, Africa. We started from scratch, buying Anadarko in Mozambique, followed by Anfa Place Mall in Morocco. We ran hard to build a scalable portfolio. Our strategy was bold, focused on strong property fundamentals, always guided by our risk gatekeepers. Our focus and drive paid off, and by 2016, we were 30 people with 7 retail and office assets in 3 countries. But there is no passion in playing small. We had to step up to the international stage. Grit was born. We listed on the London Stock Exchange, the first Mauritian company to do so, and raised $132 million for expansion. Increasingly, we had to find the way in solving asset and property management challenges, building expertise and networks to manage our expanded portfolio. Our property services business, GMS, was born. Although we focused on property investment, we recognized the groundswell of demand for bespoke property developments. In 2018, co-founders Greg Pearson and Bronwyn Knight established Gateway Real Estate Africa, rapidly becoming Africa's fastest growing property developer. In 2019, the world changed. The pandemic required a business unusual approach. Our warrior culture meant that everyone collaborated and sought solutions. We formed our family of partnerships. We realized the impact that we have on the communities in which we operate. Most of our portfolio performed defensively, but we had to ask ourselves, what does the next level for Grit look like? We're now a band of 123 specialized warriors. We now own 59 assets in 12 countries across 7 asset classes. We have the expertise to capture the entire property value chain. Now, we implement the Africa growth story. Growth from multiple revenue streams, monetizing our intellectual capital in asset, property, facilities, and development management. Growth from managing a property ecosystem. Growth from implementing a capital-light structure through co-investment opportunities. Growth from emphasizing impact income. We're standing at the edge of greatness. We're stepping into becoming a world leader in African real estate solutions that go beyond buildings. We're setting the global benchmark for property in Africa. We find a way.
So this is the inaugural Grit Group Capital Markets Day. Normally, these are a real showcase of what we're about. And today's event's at a pivotal time because we're about to conclude the acquisition of a controlling interest in Greer and APDM. And so part of today is giving you the vision about what after. Where do we go to from here? And what are the exciting opportunities available to the group?
The team that you see and the team that Darren has introduced, we have a band of emerging market warriors. And the team together came up with this vision statement. And I want to spend 2 minutes with this vision statement because often companies have vision statements, but do they really believe their vision statement? We are a family of partnerships. We are here to set a global benchmark, not just in Mauritius, not just in Africa, but across the globe. And this building attests to the global benchmark. We are here to recognize the platform that we've created. We are beyond buildings, beyond bricks and mortar. We've created a platform that's here to give smart business solutions. And this is what we'll be going through under Grit 2.0 and the opportunity that exists today and into the future. And the most important part, we are going from income to impact. So you've heard me say this often. Africa is the last frontier of growth. Every single thing that Greg and I and this management team do is across this African continent. We believe in Africa, we invest in Africa, we're here to invest for a long time. And the African growth story, the African numbers, what you see, the last frontier of growth is why we do what we do. 9 years ago, we had $100 million of investment that we were putting together. The strategy was portfolio diversification, multi-geographic, multi-asset class. $100 million of assets that we had were in Morocco and Mozambique, dealing with global conglomerates that have to be in Africa, no matter what the cycles of Africa do. Absolutely key. Multi-geographic, multi-asset class, hard currencies, dealing with tenants that can pay US dollar, euro leases. And all of this is encompassed around the partnerships, the strength of the people, the strength of our co-investors, the strength of our investors, our financiers sitting in the room. This was Grit 1.0. The evolution of Grit 1.0 has been now, we sit across 12 African countries. We have a portfolio of over $800 million. We have the diversification. But we have now looked at this platform and said, we understand the bricks and mortar. We understand the foundation. We have the foundation. We have the base. What is next? So as you will see on this particular slide, there are two components to this business, and this business under Grit 2.0. There is the current Grit-owned properties, which is obviously the bricks and mortar that we own today, our property portfolio. That is cared and nurtured for and looked after by Andries and his team, who will be spending some time on the portfolio today. There's a co-investment that we have. It's the co-investment that we have alongside our development partners at Greer, the development company, LOR. It's the future on this co-investment. The future on co-investment is that the platform has allowed us to now develop these substructure-focused real estate vehicles going forward. Donald, the MD of Bora, who will be touching on the industrial substructure today, Bora has been born now, industrial impact focused on East Africa. The ability to attract different pockets of capital to different vehicles alongside us using our expertise and what we have done over the last couple of years. This capital light strategy, people are now seeing the platform. People are understanding what Greg and the Greer team has developed over COVID, the $400 million of impact real estate. People want us to do their work across the African continent now. They might have their own capital, but they want us to execute on this. So it's the capital light strategy being driven under the property investment side of this business. And then what have we created over the last 9 years? Over the last 9 years, we've realized that property management, facilities management, leasing, any services, we cannot run on an external model. The skills, the people do not exist, or they might exist, but on a very small basis across the African continent. So we have internalized over the last 9 years all of these services. What we now see, and under the leadership of Andries on the property management, the ability to do this for other parties. The ability to service a client like American Embassy, whereby we own some of the real estate, but we might not own other real estate, where Andries can deliver a service. The ability to generate fees for the group, fees that go directly to bottom line, directly to distribution to investors. The acquisition of Greer, which I'll touch on now with regards to the closure of that, but we have bought not just a development business or a pipeline, we have bought a team. Greg and his team are the most recognized developers across the African continent, and because of delivery, what's been delivered and what's been delivered over COVID. The development management services business now has the ability to generate substantial fees ultimately for the Grit Group. Why has it been born? What have we seen in the markets over the last couple of years? We are a management team that has not gone to sleep on our real estate portfolio. We are a management team that has looked for other opportunities across the real estate portfolio. And those opportunities, as I've clearly demonstrated, is the services side of the business. We recognize that Grit trades at a substantial discount to NAV. We cannot raise capital at Grit level. We've recognized the ability to find other mechanisms, other partners, DFIs to raise capital. We are looking at recycling non-core assets. What are non-core assets for Grit? Income to impact, hospitality, retail, non-core assets. We've obviously announced the Beachcomber transaction, which closes on Friday, a substantial recycling of capital back into the business. Oti will touch on what are we going to do with that money? Where is that money going to go? It's going to go to impact real estate. It's going to go into healthcare, data centers, office accommodation, all of the stuff that you see coming out of the Greer model. That is where this recycling of capital is going to go. So I leave you with a few more takeaways for today. And on that, if there's only 6 things you go away with today, sorry to all other presenters, don't go to sleep on them, please. But if there's only 6 takeaways, what we are looking at is that whilst our London listing and whilst our premium listing has been a significant acknowledgement of what we've been able to deliver, it's created a huge amount of complexity to the group. Leon will be spending some time in just allowing you to understand the simplicity. The group is simple. Yes, it is made complicated by IFRS and a whole lot of other things that Leon will explain to you, but ultimately the group is simple. So the simplicity is important. Andries will be demonstrating that our operational performance, our existing buildings are strong. Our NOI is growing over 5%. Our vacancy excluding retail is 1%. These are strong property fundamentals to the existing portfolio. The capital allocation, what are the opportunities, as highlighted to Greg, and how are we going to pay for them? That is a very, very important question to be answered today. What does impact real estate actually mean for us? What is this term? We don't use it flippantly. Impact real estate is a key fundamental component of this business, and what does that look like? And all of this ultimately has to improve the bottom line, or why the hell are we actually doing it? And overall, it's around a really strong managed balance sheet. We launched a significant syndication last year, which the team will touch on, led by Standard Bank and supported by ABSA and Nedbank. But again, it was all to the strength of the balance sheet.
%92 of our revenue is in hard currency, reducing the risk that is often associated with investing in Africa. The occupancy of this portfolio, 95.7%. How many property portfolios in the world can actually boast that? If we take out retail out of that portfolio, 1%. Multinational tenants who are based in Africa form the basis of our client base, our tenants. And the bulk of our tenants come back for repeat business. If you see on that side there, you'll see that 15 tenants make up 70% of our revenue. And a lot of these are repeat businesses in a number of buildings. The weighted average lease expiry on this portfolio sits at 4.6 years. If you go back 4 or 5 years, you'll see that it's been tracking between 4 and 6 years, which is a strong underpin of how these leases are being renewed, how people are finding their homes in these buildings, and how they continue to stay in these buildings. The actual lease escalation sitting at 4.1%. Over the last COVID period through inflation, that has actually gone up and is now starting to settle back down at the 4.1%. But it's an underpin of how much revenue growth is still out there, which is often going to offset the impact of interest rates that have been rising. So we said earlier that our target return on our completed assets was around about 12%. Okay? If you're looking at your net initial yield, which is published, and you'll see that on all of our accounts, you can just take our income-producing assets times by that amount, that'll get you your net operating income. Your NAV growth and your escalation, that 4.1% that we often quote, that is the key determinant of what's happened to your property values. In the perfect world where there was no risk adjustments for COVID or whatever else is happening in the world, and everything else was stable, generally speaking, whatever your escalation is, that would translate directly to your property value increase. In our world, 80% of our portfolio is going to be driven by completed assets. So if you take that 12%, you multiply out your 8, you've got a return of 10%. Okay. The impact of leverage, this is the slide that Chris was showing you earlier, your net initial yield versus your weighted average cost of debt. Typically, before the interest rates have spiked, we used to have a buffer between those two. And that used to be anything from 1.5% to 2%. That helped us build up a lot of the buffer to actually pay the operating costs of the company. When it comes to your development returns, generally speaking, we wouldn't do a development unless it was going to generate 16% IRR. That means 16% of 20% of your exposure of your property is going to generate an additional 3% for us in terms of the NAV growth. Your fee income, which is generally going to be a fairly variable item, but because most of the costs that are actually included in here, which is your property operating expenses, which Andres' team does, we show that now separately as fee income, which is actually part of this, but you can see that, and that offsets your admin cost. And then obviously your net admin cost here is going to be a big driver of how you get to the end results. So we take that one step further. So let's see a typical build-up of how you can calculate what the grit returns would be. If we took our 7.9% average yield, and we took that over our income-producing asset, it comes to $65 million. If you take our income-producing assets, you times it by the 4.1%, that roughly gets you $33 million. So that's from the completed assets. Your development returns, we currently sit at roughly $150 million of assets under development at any one point in time. If you take that 20% revaluation gain you will get, but that's generally over a period of 18 months, you work that out, gets to roughly $15 million of asset growth. Your fee income, $4.5 million, which is roughly 4.5% of your development assets over that period of time, and your property management fees, as I mentioned earlier. Your debt costs, take your total debt cost times your weighted average cost of debt, and that component that Chris was explaining earlier, your cash cost of debt, and your amortizations of your debt fees, means that from a cash basis, 34 million and 3 million that you're actually writing off on your debt fees. That gives you, and a total admin costs, which is a percentage, which we disclose all the time. That gets you roughly to where you can see the total return build up over a period of time. Obviously, this is just taking a quick snapshot of the numbers that's available, how you can build it out, and generate your own view of what's happening in this business before you start overlaying your own views and thoughts. So this is an important slide. What we've seen here is trying to get to grips with what's actually happening in our business, trying to explain to ourselves what's actually driving our share price. So if we just park for one side that the entire world's property stocks are trading at deep discounts to NAV, we also have to understand that the COVID environment and what we did over COVID has also affected it. But you can also see now how it's going to come back. So you'll see that we always used to pay a dividend yield of roughly 8.5%. Over COVID, it dropped significantly, 3.86%, 2%, and you can see that correlation in your share price versus your NAV. Obviously, the NAV came down with the property valuations that are coming down, and then we started to pay dividends again, and where it sits currently, which shows you the trajectory of where the share price could go back to, because at these levels, we were trading roughly at net asset value. So as the property sector starts recovering, people's sentiment towards property comes back, everything within the numbers is showing it should come back. But obviously there's market forces that we are not yet able to control. I wish we could. And then just looking at our total targets, as mentioned earlier, 13 to 15%, which is now with the integration of the Greer assets that will come in. The breakdown of that's still going to be around about 8% as a dividend yield, and the balance through valuation growth on the assets. So these are just the medium-term targets that we've set ourselves. 12 to 15% total return over the medium term. Annual growth in assets, anything from 4 to 7%. And then the targets which we put before, 4.5 to 5.5 is the expected distribution, the target distribution for this financial year. Share price, the net asset value, 78 cents to roughly 85 cents in this range. And LTV, 38 to 44%.
We have access to capital, even though we are not able to raise capital from a London-listed perspective or from an exchange perspective. We have access to capital. We've raised it, and we're looking to recycle out of our non-core assets, and we're looking to prove the valuation by exiting at near or above book value. And we'll look to deploy this capital in other growth opportunities within the group, and we'll look to reduce any expensive debt and re-optimize our balance sheet to propel it for further growth into the future. Those that are already invested alongside ourselves were able to seek investment opportunities together. I think we've done that very well with the likes of LLR, where we invested together in Orbit in Kenya. We also have these opportunities available to others within our family of partnerships. We also have the opportunity to raise alternative funding from mezzanine financier or other alternative capital providers. Earlier last year, when we concluded the Orbit acquisition, we were supported by the likes of Blue Peak and Ethos, where we raised capital, specific capital. Donald will later touch on Bora, but Bora is the beginning of many ways where we're looking to repackage some of these portfolios and come up with these businesses that pursue specific opportunities alongside our IP that we can support these entities. And at these substructures, we're able to then raise specific capital that's chasing these opportunities. There are many benefits of asset recycling, and to ourselves, there are three which I'd like to highlight for you today. Our portfolio is independently valued annually by Knight Frank and REC. Our asset recycling strategy has proven that the value that sits in our books is tangible, and we're able to realize that value because we've been able to realize our exits at near book value, and in some instances, we actually exited at premiums to net asset value. The second benefit for asset recycling is to really take that cash, redeploy it in debt reduction, and really bring down our financing costs and our LTV in the medium term while we look to redeploy this cash into long-term assets holdings. The third benefit is to really take this cash and then redeploy it into those opportunities that provide more yield. As of the 1st of May, we've actually recycled $135 million back into the business, some of which went towards the acquisition of our Greer portfolio, and some have been used towards debt reduction. Let me take this opportunity just to maybe walk you through some of the key disposals that we realized in the recent past. We exited the Absa House at near book value, where we generated about $4.2 million of equity back into the business for growth. So we sold back the Beachcomber assets back to Beachcomber, and we were able to realize a near book value in our exit. I'd like to touch on our focus. I think Gregory spent a bit of time and spoke about those pillars that we look to concentrate in terms of our pipeline for the future. Bronwyn did say that hospitality and retail are our non-core industries, and we're either looking to downscale our holding into these, and where possible, completely exit some of these sectors. We have those sectors that we believe are very important for that African growth story in terms of impact. I think from where we're sitting, we're looking to walk amongst our communities to create that sustained impact in the African region. And we've identified the industrial sectors, that diplomatic housing sector, and that data center sectors as those core sectors that we look to really cement our position in the market. We have those other sectors that we'll look to grow and build our credentials in, such as your medical, your office spaces, and other corporate accommodation across the African continent. And this is how we would look to execute on our pipeline and growth story into the future. Greer brings into the group stable the opportunity to now start generating developmental yields. And we currently develop at the minimum 10.5% development yield. What this means is we're able to then re-rate this development yield into valuation yield that comes into our books and really improve those returns for ourselves. As you can look at some of these sectors, such as your retail and your hospitality, we've historically been generating about 6.5% yields. We look to recycle these sectors and then redeploy into the new Greer pipeline. And then we have relationships with DFIs, with alternative investors from the likes of PE or mezzanine finance. And we also have some financial engineering within the group in terms of reorganizations that we use to raise this funding. At this point, I would like to call on Krish to come in and really walk us through how we manage any cash and liquidity within the group.
So the 3 points is to talk about liquidity and repatriation risk. The second one, hot topic of the day, interest rate risk management. I'm here looking at my co-investors into Greer, the PRC guys. That was one of the questions from them. And the third item is the refinance risk of the portfolio. As everyone would know, pure maths, it means that your asset yield needs to be higher than your weighted average cost of debt. If you're not meeting these returns, then you need to repay down debt. Where are we today? We are living in a world where the interest rate is actually hiking. Okay? So what is management actually doing when it comes to the global hikes in the interest rate? I'm actually going to show you about how we're going to improve the yield when it comes to the assets under the portfolio right now. My colleague Oti spoke about the recycling of capital, disposing of non-core assets, being retail and hospitality, and reinvesting into what you call impact investments going forward. Assets that will be generating a minimum development yield of 10.5%. The second point that I'd like to touch on is how we're going to improve the weighted average cost of debt. Firstly, is by disposing of what you call the non-efficient debt on the balance sheet. And the second point is interest rate hedge that we've got right now at the GRIT group. The third point is how we're going to be talking about the reduction of the debt. My colleague Oti. Greer has been funding asset at a property level. It's because of the risk that we take on at an asset level, depending on the project that we do and the counterparty risk that we take on, right? So we have been doing property by property financing. This is the first point. The second thing that Greer has been doing to date is we are locked into not locked into, but we've been doing amortizing debt facilities for our development-related assets. Actually, want to touch on, because we've had a couple of questions on this, is how do we manage the day-to-day cash flow of the actual propcos and actual investments of the entire group. So the first thing that where Treasury gets involved is how do we register the capital that gets injected in the country in which you're going to be investing. Do we have the laws in this country that allows us to be able to charge the rental in dollars? And are we going to have the tenants that will be able to pay us back in dollars? That was a point that our dear CFO mentioned early on, is ability for our tenants to pay us in dollars. The third point that I'm going to tackle is ability to be able to repatriate these funds from the propcos to Mauritius, also in dollars, as soon as possible. All right, I'm going to use an example, talking back to my CEO here, an example that they used on ADC. ADC is an asset that was funded purely by equity. plus minus $20 million of equity that was injected by Agria and refinanced on completion. Because of the tight deadline that we had in this project, this is the best structure that had to be done, all right? So, of course, ADC is the data center in Nigeria. I'm sure many people out here will tell us, guys, why did we invest in Nigeria? But we did invest in Nigeria because we could place this investment into what you call a special economic zone. When it was placed into the special economic zone, we were able to charge the rental into dollars. We were able to repatriate the rental into dollars. And our tenants was also able to pay us in dollars. As you would know, in Nigeria, it's impossible if you're outside of the economic zone to charge rental in dollars and to actually repatriate the funds in dollars because you don't have access to the dollars. But when you're in the free zone, it's very, very easy and you have the special dispensation to be able to do that. Okay. Now, what we do is on collection of these rental income, we repatriate these funds to Mauritius as soon as possible, right? We don't allow these funds to remain in country. We actually repatriate it back to Mauritius. This slide talks about the currency indication, which expires by year 2027. And if we achieve certain financial targets, our cost of funding can be reduced by 0.4 basis points, right? The second point that I'd like to talk about is this indication has actually reduced the cost of financing in two specific countries. If you look at the sovereign risk right now in Ghana and Zambia, refinancing these structures just by themselves would have been a bit difficult, including them as part of the big cross-collateralization that Grit managed to do. We were able to save between 300 to 400 basis points by doing that. I would please advise you to look at the cash weighted average cost of debt column. And the reason for this is because, to everyone out there, the difference between the weighted average cost of debt and the cash weighted average cost of debt, the difference is due to the debt structuring cost that has already been paid by the group. I would also ask you to focus on the slide on the right-hand side, because that mainly focuses on the dollar debt. Post the BHI disposal, the Grit exposure to euro debt will be very, very minimal, right? So if you focus on the right-hand side, you will see that the cash weighted average cost of debt, the current one, is about 7.8%. Through the interest rate hedge that we've got in place today, even if the interest rate goes up by 200 basis points, we're only going to see a 0.5% change in the interest cost. And also, we've actually got a collar and caps interest rate hedge. So even if the interest rate drops by 100 basis points, we're actually going to see a saving in our cost of finance by 1.1%. Okay. During the COVID pandemic, the LTV at Grit, most of the shareholders will realize or will remember, the LTV was at 53.1%. Okay. As at 31 December, the LTV at Grit was 45.5%. This is a major, major achievement, right? Post the Project Low transaction, meaning the acquisition of the Agria assets, and remember that Agria has got a very low LTV, that will drop the LTV from 45.5 to an approximate amount of 42.6%, and we are not far from the target of 40%. Today, we also have the legal structure. When we did that cross-syndication at Grit, we've actually done two things in one go. We managed to secure the syndication, that's the first point. The second thing is we now have a legal structure that does allow us to raise a corporate bond within the next 2 to 3 years. So this is the
where we sit today is we have a portfolio that will, on completion, be valued at just on $480 million. We have a 97.6% hard currency collection in leases. Again, that statistic for us mitigates a lot of the risk of why we're doing the developments in Africa. And to date, we've achieved an over 16% return. So where we started to where we're going, what's changed? We sat down at this point in time to say, how do we align with the bigger strategy of Grit? And with regards to our developments, we've got 15 clients that we're working with that are providing the majority of our pipeline. How do we focus on that and grow that even more? So the developments that we do are bespoke. The reason why our tenancy is sitting so high is because on the majority of our developments, we are pre-let before we start. So in 2018, we started on zero. You can see some of the assets that we have developed through time. Piling up very, very quickly. Our current development team has the track record of developing between $150 to $200 million a year, as is. That's without employing one other person. Again, there aren't any developers that have that track record and have the experience and IP in the countries that we can operate. What we are doing is we're creating global firsts and global best practice in Africa. We've got a string of accolades that the team have received in the last couple of years as the buildings come to fruition and complete that recognizes what we've been able to put back into the market. Where we can pick and choose is the countries that we invest in. Obviously, as I mentioned earlier, we are super involved in all the different aspects of that development and the end user. There are some countries that have higher taxes than others. So what we're doing at the moment is we're pushing forward on the more lucrative projects and the more lucrative countries. Hence the reason why we're talking about Kenya and Ghana specifically, because they've come to the party with regards to relaxations on certain tax items that gets us the returns that we need to push forward. If we look at an instance like Moderna went out to the market in Kenya to say they're building an international facility where they will manufacture in country. On an instant like that, where we've got a client that wants to spend their own capital, do their own development, design and build to a certain international standard, we have the capability to do that. At the moment, we've got a selected pipeline that is ready to go of circa $320 million, which again is substantial. It almost doubles the size of our business of where we're sitting today that are ready to move forward. And our extended pipeline of where it's tangible, there's MOUs in place, there's a high-level meeting of minds. We're sitting circa $660 million. Again, the amount, the equity that comes in and the recycling of capital that my colleagues have spoken about earlier today, we have got a definitive place to put it, and straight away what that does, it generates fees back in for distribution. So we've got 4 pillars that we are really focused on. And what I mean by that is we are the global benchmark for Africa when it comes to these 4 pillars that we are rolling out. So within medical, we will be doing a site visit on the island tomorrow. We are launching the new state-of-the-art best medical facility in Mauritius, phase 1 of 2. That is backed by Artemis and Falcon Group, which is probably, it is groundbreaking for Mauritius. It is a new type of healthcare system. And the opportunity that we have got with healthcare moving forward is huge. Because of what we've done here and how the link is on the G2G, the wrap that we've done on insurance to guarantee the income and the length of lease, again, we're mitigating a lot of risk and we've been able to provide a healthcare solution for a country. Moving on to corporate accommodation. So within the US named OBO, the US Embassy, we have had a very strong track record and a very long relationship with them. Myself personally, I've worked with the department since 2006. Within GRIT, they have been a cornerstone to our investment case from day one. Where we stand today and the developments that we are doing with them, the expansion that they have for the African continent is massive. But again, the pipeline and the strategy moving forward with regards to diplomatic housing, we've now had other embassies contact us to say, we've seen what you've done with OBO, we want to replicate exactly that same thing across the continent. Industrial pipeline, I'm going to leave the detail of that to Bora, which is a very interesting impact that we've got. The last pillar is data and call centers. So there's 2 case studies that I'm going to touch on here. If we can touch on CCI first. So we're doing a new development for CCI in Kenya, in Tatu City, with our partner Endeavour as the landowner. But CCI came to us during COVID with a problem. And their problem was there's X amount of jobs, 1.5 million jobs that sits in the Philippines today that have a call center strategy back with the US. During COVID, the likes of the Amazons, AT&T, American Airlines, and a whole lot of other conglomerates were literally taken to their knees because the Philippines had shut down over that COVID period. So their call center lines weren't open. So CCI had a mandate to move 1.5 million jobs to Africa. You've got Ambassador Meg Whitman that sits in Kenya at the moment that's been strategically placed there by OVO to grow the business strategy for America across the African continent. Now, why this is so pertinent to us is this the family of partnerships. The partnership that we had with CCI is we have entered into an agreement with them that we will provide all of their real estate needs across Africa. We've also got further involved in the business to understand the needs of what they require to get the call center seats back to our continent. And what that means is it's cost per seat. So every person that they put on that seat has to come into a certain cost base for them to be competitive. Now, real estate plays a massive part in that. The SEZ plays a massive part in that. So the business strategy that we put around, again, is not just brick and mortar. It's the family of partnerships from A to Z in understanding their business case and why we needed that done. So today we're building 24,000 square meters of A-grade office building in Kenya specifically for CCI. That building is pre-let before we start. We've got two fantastic architects doing that building as well. So we're going to have we've got quite a few now in our portfolio that we've done together. But it's going to be a world-class building.
So how are we creating this impact? Our ESG strategy is on the back of the United Nations Global Compact SDGs. As part of this strategy, we have set ourselves some targets. On the environmental side, all our new developments have standards in place to ensure that ESG principles are embedded in our design from the onset, so that we are accredited with an IFC EDGE or a green building where applicable. It all is in line with the drive of creating healthy buildings for Andries to take over. So our target for 2025 is to reduce our carbon emissions by 25% and improve building efficiency by 25%. And I'm very proud to share with you that we are on track with the 14% and 16% respectively. Apart from being a London and Mauritian Stock Exchange company, we are also members of EPRA and the UNGC, and our policies and procedures speak to this. As a women-led organization, women empowerment and gender equality is very important to us. And so we have 41% women in leadership positions, exceeding that target of 40%. We aim to improve the Mauritian economy, and by that we have a target of 65% local representation, exceeding that target to 77%. Our founders, Greg and Bronwyn, are very much impact-driven and are focused on creating a sustainable legacy. And so they have established the Good Foundation, a foundation that is there to support human development and protect the climate. So I'm going to take you on a little bit of a journey. And this journey basically shows you just some of the social impact investments that we've been involved in and have invested in.
Rugby is a sport for all. It doesn't choose sizes. It doesn't choose your background. It doesn't choose your height. We work with communities in the major slums in Nairobi.
Quand vous accueillez les gens, les personnes surtout à leur âge, à la fin de vie, être dans un lieu convenable, propre et leur redonner le goût de vivre.
Grit wanted to help All Life Matters with its cause of being an animal sanctuary helping the communities, and helping with sterilization.
Construction is very male dominated. The sector currently employs 3% or less of women.
Our work is to rescue children of imprisoned mothers.
They haven't had a chance to build visions of their life. And so we enable women to be able to look at themselves as a priority by giving them skills and tools.
Before Build Her, I would not be able to sustain my kid. I would not be able even to afford the money for Pampers. But now when I got a job, I'm able to provide for school fees.
Just last year, 5,280 animals got sterilized. We've probably got about 16 people employed, and we have so much improved their lives.
This building is specifically for the girls. Our dormitory right now, we do not have a place where we can keep the adolescent girls to give them their privacy, and we also increase their numbers. And that is why we need this support so that the building can be complete and the girls can have more room.
GRIT coming in is really big for us. It's helping to support more than 2,500 kids. One of the biggest impacts that GRIT make on our beneficiaries is with the trip of our under-15 team going to France during the France World Cup. This has contributed before to kids coming back and doing well in school. They end up being great people in the society.
Certainement, ces travaux nous ont beaucoup aidés. Très reconnaissante pour la compagnie GRIT.
The collaboration between GREA and Build Her is very important. They see the impact that you're contributing to the society. They see how important it is to support women's empowerment and integration into construction, and they want to be a part of that.
So thanks to GRIT, at the end of each month, I'm able to do my salaries, buy food, buy the medicines, and I cannot be more grateful.
When we do a new development, as part of our feasibility study, we always include an ESG budget in there. Apart from that, when we in a specific country, we have an ESG task team. And that task team is there to basically focus on 3 Ps: the people, the planet, and the profits. And that's where we actually focus on how we're going to make the building green enough. And that speaks to the planet. And what social impact initiative is available within that community in which our building resides. So that's a little bit about how we undertake these social impact initiatives. A case study that I'm going to show you is around Build Her, and you've seen it in the video as well. Build Her is an initiative that both GRIT and GREA are immensely proud of, an initiative where we've been able to make a tremendous impact on the lives of women within a male-dominated industry. And a little bit about Build Her. It's basically an NGO situated in Kenya, and they take underprivileged women and train them with artisanal skills within construction. So basically teach them how to lay bricks, lay tiles, how to put joinery items together, and so forth. We sponsored this investment as part of our Rosalind Grove development in Kenya. And these women, 22 of them, were then employed on our Rosalind Grove construction site. And they were then able to take their learnings from this training and development and gain practical experience on our construction site. I'm very proud to share these statistics with you. We will also soon be an ISO 45001 accredited business, which shows how important health and safety is to the core of our business. We've created Bora Impact Industrial, which Donald has taken us through, and we now have a focused impact market sector strategy, which we're also very excited about delivering. What's next? Creating more impact investment opportunities that go beyond buildings. Thank you.
So thank you. I'm Andri Smit, Head of Real Estate. I'm also the new Managing Director of GRES, GRIT Real Estate Solutions. That is the new fee-generating opportunity that we see within the GRIT business. How long does it take us to manage that asset? I take that bird that he hands to me. We nurture that bird going forward. Because at the end of the day, it's your asset that I have to look after for the next 20 to 25 years. So for us, it's a very important handover to make sure that the yields that they are projecting, that they are saying that they can make out of this asset, we as a team of real estate specialists have to make sure that at the end of the day, that 80% that Leon was talking about, that our target is that we achieve that. Guys, yeah, what is the solution that we bring into the table? Asset management, facilities management, and property management. Later on, when I do a little case study of Ethiopia quickly, I'll explain to you how all this fit into my team's roles that we are fulfilling within the GRIT group. Our capability at the moment, we've got 1.2 billion assets under management, 639,000 square meters of GLA, 497 tenants that we are managing in 12 African territories. I've got 7 in-country teams, and I've got 101 employees. Our occupancy and cash collections, that is from strong operations, collections, and can make sure that the leasing that we are doing is of world standard. We've just in 2020 we've signed a Vodacom lease, 5-year renewal, Majorel leases. We've signed in Ghana, Total. We've signed the 11-year lease in Commodity Phase 1 in Mozambique. Talo in Ghana as well, 5-year renewal. So we've got very strong leasing activities. Case study, Ethiopia. I spent roughly 3 months there to mobilize the site. If we talk, we're mobilizing the site, so we take over the site from the construction or development team, then we make sure that all the facilities is up and running within that site, and then we hand over to the property management team that will run that facility going forward. So this is a very good example actually where we have done the property take on, and also where we trained our people going forward to do additional work. So we are doing the full facilities management, property management, and asset management work on this property, all external fees that we are actually collecting from this property. We are moving from a cost center to a profit center. This is the GRIT current portfolio, $575 million that's under management, and all the supporting structures, $410 million. We are targeting $100 million additional work within the next 3 years. My team and the in-country teams I've got at the moment, it's myself, Head of Asset Management, Craig Leach, Head of Operations, Marika Pieterse, Head of Leasing, Debbie, and Rui Moka, my Head of Facilities. And these are some of the in-country heads that we've got in the...
Sorry guys, let's see if we can first slide here. I seem to have lost the slide. Anyway, good afternoon. My name is Donald Borthwick. I've been entrusted with looking after Bora Africa, which is one of the substructures that's being set up in GRIT, and that's going to be looking after industrial properties. I've been a property developer for over 30 years and been working in the Africa space, largely surrounding GRIT for the last 10 years. Bora Africa is the new name for this entity. Bora is a Swahili word. That means good, doing good. And this links very much through to the sort of genesis of this fund, which was Africa, impact, and industrial, the real key drivers for what we're doing. I think if we start off with Africa, Bronwyn had talked very quickly about the Africa story, why we see the growth there. I think you have perhaps all heard and seen the stories: urbanization, growing mega cities, a high youth population, demographic dividend, and then ability for renewable resources, which are going to be very effective there. The corporate structure that we're setting up. Bora Africa will be based here in Mauritius. That's all the sort of the corporate head office. It will be run from Kenya, from Nairobi. So essentially we'll have Grit staying as the majority shareholder, opening the possibility for co-equity investors to come in, and then a space where there's a lot of interest and a lot of demand is for preference share type capital or hybrid capital. Which can come into the vehicle. What we haven't talked about here too much is also a possibility for people to come into the asset level. A quick snapshot of the seed assets coming in. Okay, we've got a very exciting pipeline, and I think as Greg was saying, we get stuff done. We find the way, and there's no surprise. People approach us now to get developments done. So I'd say we've got three kind of categories there. We've got greenfields. There are 3 data centers that we're busy working with. We really like the data center space. There's also a large solar manufacturing plant, which is making good progress. That's going to be a fantastic project. We really hope that it closes. Brownfield, we've got land next to Imperial and some land in Kenya that we'll be looking to do some developments. And then we've got 2 acquisition assets, nice properties in Nigeria that we're working towards getting hold of. That gas resource is too big to be ignored, and there's posturing going on about when Total will pull the trigger. They achieved FID to go ahead and then called force majeure, and that's basically untangling. We can operate in Mozambique, okay, as a group. We've built stuff there, a lot of stuff. We've got good assets. We've got an unbelievable team with Henri. So we are ready to react there. So it's a deep water port. The raison d'être was to get access to Ethiopia and South Sudan. And everybody says it's not been built. It's just it's a complete nonsense. Well, guess what? We were there last weekend. The port's finished. The logistics are the logistics, the connection is not there, but this is the kind of stuff where there are going to be opportunities that we're ready to pounce on. Okay, and then just a last discussion then on the IFC. We've got wonderful support from them, and the other TFIs are also expressing a lot of interest in what we're doing. And I think it's really from them. It's just seeing impact. Okay, it's really very simple. Really making a difference in all of these places.
So really, on that note, just to have some closing remarks, the family of partnerships setting the global benchmark, not just in Mauritius, not just in Africa, but the global benchmark. The creation of these smart business solutions. Not just being a bricks and mortar, understanding the platform and understanding the ability to monetize the IP and provide investment solutions for other parties. The impact real estate. And that impact doesn't just sit in this video. It sits with team members, the people we have in this organization. The impact is real, and it is so close to our hearts. And that's why this income to impact couldn't be better positioned for Grit 2.0. And ultimately, all of this is beyond buildings. We have the bricks and mortar, but it's not the bricks and mortar. It's the feeling. It's the emotion. It's how you feel when you come into one of our real estate assets. And that's the difference. That's what differentiates us from all other businesses out there in Africa and across the globe. And on that note, thank you for enduring a relatively long day